Imagine unlocking, well, the ultimate financial shortcut. Saving tens, maybe even hundreds of thousands of dollars on your taxes year after year. How? Simply by mastering a few core rules about your investments. Today, we're embarking on a deep dive into the intricate but incredibly rewarding world of capital gains and losses. We're armed with the 2024 IRS instructions for Schedule D, and we're not just looking at this as a compliance guide. No, think of it as a roadmap to some really powerful tax optimization. Our mission today is pretty clear: to equip you with the crucial knowledge, the strategic insights you need to manage your investments with, frankly, remarkable tax efficiency. This isn't just about filling out forms correctly. It's about strategic financial planning that can really fundamentally change your long-term wealth picture. And to guide us through this landscape, turning these sometimes dry instructions into actionable gold, we have our resident expert with us.
It's absolutely true. While these documents are labeled instructions, they really are a blueprint for significant tax savings. We're going to demystify the critical distinctions, maybe expose some overlooked opportunities, and definitely reveal the nuances that can truly impact your financial bottom line. Our goal really is to move you beyond simply, reporting what happened last year.
Right, reactive reporting.
Exactly, to active optimizing your financial picture for the years ahead.
Okay, optimizing. I like the sound of that. So let's unpack this with the absolute fundamentals. When we talk about capital assets, what exactly are we referring to?
That's the foundational question, isn't it? At its heart, a capital asset is, well, most property you own either for personal use or as an investment.
Okay.
The IRS instructions themselves give some pretty clear, everyday examples. Things like your primary residence, your furniture, your personal car, stocks, bonds. These are the common items that typically fall under this very broad umbrella.
Right, the things most people think of as assets.
Precisely. But here's where it gets really interesting and actually critically important for your tax planning. Understanding what isn't a capital asset.
Ah, the exceptions.
Exactly. The IRS draws a very sharp line here, because if something doesn't qualify as a capital asset, its sale isn't governed by these capital gains and losses rules we're talking about today. Instead, it falls under ordinary income or loss rules, and those carry very different tax implications, often less favorable.
Okay, so that distinction matters a lot.
It matters immensely. Think about that car you mentioned. If it's your personal vehicle, used for family errands, weekend trips, it's a capital asset. But what if you're, say, a professional delivery driver, and that car is exclusively used in your business? Maybe you've even been depreciating it for tax purposes.
Oh, okay, different use.
Totally different use. In that scenario, it's generally not a capital asset for tax purposes when you sell it. Any gain or loss might be treated differently. And this distinction applies more broadly. For instance, inventory that's property held primarily for sale to customers in the ordinary course of your trade or business that's explicitly excluded.
Makes sense, like a shop stock.
Right. The same goes for accounts or notes receivable you acquired in the ordinary course of your business, or, say, from providing services as an employee. So if you're a graphic designer, those unpaid invoices, not capital assets. Similarly, depreciable property used in a trade or business, or even real estate used in a trade or business, that often falls outside the capital asset definition too.
That surprises some people, I bet. Real estate used in business.
It does, because these are significant assets. Furthermore, certain self-created intellectual property.
Yeah.
Think like a patent you invented or a book you wrote. Generally not a capital asset unless you make very specific elections. Even things like U.S. government publications you received for less than their normal sales price, or just routine supplies used in your business, not capital assets. The real takeaway here is that the purpose why you hold an asset profoundly dictates its tax treatment when you sell it.
That's a really crucial clarification. Purpose dictates treatment. Because as you said, it determines whether you're looking at those potentially favorable capital gains rates or maybe less forgiving ordinary income rates. Okay, so once we've confirmed something is a capital asset, the next big piece of the puzzle, the one with immense tax implications, is the holding period.
Absolutely.
This seems to be the bright line between short-term and long-term, and it directly affects your tax bill, right?
Directly. Massively. In most cases, the rule is pretty straightforward. If you've held an asset for 1 year or less, any gain or loss from its sale is considered short-term. Hold it for more than 1 year, and it generally becomes long-term.
1 year or less. Short. More than 1 year.
Yeah.
Got it.
And that distinction, short-term versus long-term, it isn't just some technicality the IRS cooked up. It's really a fundamental driver of smart investment strategy. Why? Because long-term capital gains often qualify for preferential, significantly lower tax rates compared to your ordinary income tax rates.
Which could be much higher.
Exactly, much higher. This structure incentivizes investors, to hold on to their assets for longer periods. It allows wealth to compound more efficiently without the drag of higher taxes each year. It's why you often hear investors talk about having a long-term mindset. The tax code actively encourages it.
So patience pays off, literally on your tax return.
It certainly can. Now, while the general rule is that simple, more than 1 year, it's worth noting, and the IRS instructions do highlight this, there are subtleties. There's a specific complexity for certain applicable partnership interests. For these specific cliques of interest, the long-term holding period actually requires more than 3 years to get that preferential tax treatment.
3 years. Okay, that's different.
It is. It's a bit niche, maybe, but it perfectly illustrates that even within seemingly simple rules, the precise definitions and exceptions really matter. You can't just assume the general rule always applies.
Good heads up. So strategically timing your sales around these holding periods, aiming for that more than 1 year mark in most cases, can unlock significant tax savings. But okay, before you even think about selling, timing aside, you absolutely must know your basis.
Couldn't agree more. Basis is fundamental.
So what is basis? It's essentially your investment amount in a property for tax purposes, right? Typically, it starts with the cost.
That's the starting point, yes. Think of basis as the financial DNA of your investment. It's the bedrock for calculating any gain or loss when you eventually sell or dispose of that property. And getting this wrong, well, you could be significantly overpaying your taxes or underpaying, which brings its own problems.
Right. Accuracy is key.
You're absolutely right. Basis is everything. And to build on that, accurate record keeping, it isn't just, good practice. It's absolutely non-negotiable for tax purposes. And it's a long-term game. Your basis isn't just what you initially paid. That's just the start.
Okay, so what else goes into it?
Well, you need to include things like commissions you paid when you bought the asset. Very important. Crucially, your basis also increases with the cost of any capital improvements you make to the property. Imagine adding a new room to your house or a significant upgrade to an investment property. That adds to your basis.
So keep receipts for major improvements.
Absolutely. Forever, ideally. Conversely, your basis can decrease. This happens due to factors like depreciation you might have claimed over the years, particularly on business or rental property, or non-dividend distributions you've received on stock, sometimes called a return of capital, or even adjustments for things like stock splits or stock dividends.
Wow, okay. Lots of potential adjustments over time.
Exactly. And without precise, detailed records of all these adjustments over the entire holding period, which could be decades, you're essentially flying blind when it comes time to sell. You might overstate your gain and overpay taxes or understate it and risk errors, potentially leading to an audit. The IRS provides extensive guidance, and the Schedule D instructions point you to specific publications like Pub 5FAF1 on basis of assets for the nitty-gritty details. This is why, honestly, a meticulous spreadsheet or reliable financial software is one of your most valuable tax planning tools. It's not optional if you want accuracy.
Non-negotiable, you said. I believe it.
Okay, so you've done your meticulous record keeping, you've calculated your basis accurately, factoring in all those adjustments. Now you need to report the sale. For most people, that means dealing primarily with 2 core IRS forms, right? Schedule D and Form 8949. That's correct. Those are the main players here. Schedule D is essentially your summary sheet. It's where all your capital gains and losses for the year get aggregated to determine your overall net gain or loss.
The big picture for the year.
Exactly. Form 8949, on the other hand, is where you detail each individual transaction. Think of it as the meticulous ledger. Every specific sale or exchange gets listed there, one by one, with all the details, description, dates, proceeds, basis.
Okay, Schedule D summarizes. Form 8949 details.
Precisely. And here's where things can get, well, a bit more efficient, potentially saving you a considerable amount of time and paperwork.
Oh, efficiency is good.
Definitely. The instructions highlight a streamlined reporting option for certain very straightforward transactions. If your broker reported the basis of your assets to the IRS on your Form 1099-B, and you'll see a box checked on the 1099-B if they did, and there are no adjustments needed to that basis or the type of gain or loss reported, and you're not dealing with something complex like a qualified opportunity fund election, then you might not need to file Form 8949 at all for those specific transactions.
Really? Skip Form 8949 entirely?
For those specific simple transactions, yes. You can simply report the aggregate totals directly on Schedule D, line 1A for short-term totals, line 8A for long-term totals.
Wow, that sounds like a game changer for people with just standard brokerage accounts, selling stocks or ETFs where the broker tracks everything.
It absolutely is. For example, say you sold some stock you held for 3 years. You got $6,000 for it. Your original cost, your basis, was $2,000. If your broker reported that $2,000 basis to the IRS on the 1099-B, and you don't need to make any adjustments, you just sum up that $4,000 gain with any other similar long-term transactions that meet the criteria and put the total right there on Schedule D, line 8A. No Form 8949 needed for that specific sale.
That's a fantastic simplification. But let's be crystal clear, there are still times when Form 8949 is absolutely required, right?
Oh, absolutely. You still need Form 8949 in several key scenarios. For instance, if your broker didn't report the basis to the IRS, this might happen with older investments, maybe stock bought before brokers were required to track basis, or certain other types of assets.
Okay, basis not reported means Form 8949.
Correct. Also, if you need to make any adjustment to the basis reported on your Form 1099-B, or an adjustment to the gain or loss amount, for any reason, maybe wash sale rules, which we'll get to, you need Form 8949. It's also necessary if you're electing to defer income because of an investment in a qualified opportunity fund, or if you're making certain other specific elections or adjustments, like claiming an exclusion we'll discuss.
So any complexity, any adjustment, basically pushes you back to Form 8949.
That's a good way to think about it. The IRS gives a practical example. If your Form 1099-B shows proceeds of $1,000 and a basis of $5,000 for a stock sale, but the broker didn't check the box indicating basis was reported to the IRS, you must report that $4,000 loss transaction on Form H-949. This ensures the IRS gets the complete picture, and importantly, it allows you to make any necessary adjustments or provide additional context for that transaction.
Got it. So the simplified reporting is great when it applies, but Form 8949 is still essential for anything non-standard or needing adjustment. Okay, now that we've got the fundamentals down, what's a capital asset, holding periods, bases, the reporting forms, let's dive into the really exciting part. The high-impact tax-saving strategies.
Yes, the payoff for understanding all this.
Absolutely. These are the opportunities buried in those instructions that can significantly reduce your tax bill. And for many, many people, arguably one of the biggest potential windfalls comes from the home sale exclusion.
A huge one.
Right. This allows you to exclude a substantial amount of gain up to $250,000 if you're a single filer, or a whopping $500,000 if you're married, filing jointly from the profit you make when you sell your main home. Considering for most people their home is their largest asset, this exclusion can literally save, as we said, tens, even hundreds of thousands of dollars in taxes.
It's incredibly powerful, but it's crucial to understand it's not automatic. You need to qualify. You need to satisfy two main tests.
Okay, what are the tests?
First, there's the ownership and use test. During the 5-year period ending on the date you sold your home, you must have owned it for at least 2 years.
Owned for 2 years.
And you must have used it as your main home for at least 2 years. Those 2 years don't have to be continuous, but they both need to add up within that 5-year window looking back from the sale date.
Ownership and use, both for 2 out of the last 5 years.
Correct. Now, here's an interesting point often missed for joint filers. Only one spouse needs to meet the ownership requirement to potentially get the $500,000 exclusion. However, both spouses generally must meet the use requirement to qualify for the full $500K. If only one meets the use test, you might be limited to $250K.
Ah, okay. Nuance for married couples. What's the second test?
The second test is simpler. Basically, you haven't already used the exclusion on the sale of another main home during the 2-year period ending on the date of your current home sale.
So you can't use it every year, basically. Prevents flipping houses tax-free repeatedly.
Exactly. It prevents serial exclusions. Generally, it's once every 2 years, providing you meet the ownership and use tests on the new property as well.
Okay. Ownership, use, and haven't used it recently. Seems straightforward enough.
Generally, yes. But here's where the IRS shows some significant flexibility, and this often goes overlooked. Even if you don't fully meet one or both of those 2 tests, the 2-year ownership or the 2-year prior exclusion rule, you might still qualify for a reduced exclusion.
A reduced exclusion? How does that work?
This is a crucial safety net. It applies if the primary reason you sold your home before meeting the 2-year requirements was due to certain unforeseen circumstances. The main categories are a change in place of employment, significant health reasons, or other specific unforeseen events defined by the IRS.
Like needing to move for a new job suddenly.
Exactly. Or maybe needing to move to care for a sick family member, or even because of divorce or separation. If you sold your home after living there for, say, only 1 year because of one of these qualifying reasons, you might still get a portion of that exclusion. It's prorated based on how much of the 2-year requirement you did meet.
Yeah.
IRS Publication 523, Selling Your Home, has the detailed worksheets, but the core insight is life happens, and the tax code offers some understanding and partial relief in those situations.
That flexibility is a huge relief, I imagine, for people facing unexpected life changes. That's really good to know.
It is, and the instructions highlight even more special circumstances.
Oh, like what?
Take, for example, a surviving spouse. You might still be able to exclude up to the full $500,000 of gain, not just the $250,000 single filer limit, if the sale happens within 2 years of your spouse's death.
Wow. Okay. What are the conditions for that?
There are a few conditions, but essentially, just before the spouse passed away, both of you met the use requirement, at least one of you met the ownership requirement, neither of you had used the exclusion on another home in the prior 2 years, and importantly, the surviving spouse hasn't remarried before the date of the sale. If all that lines up, you can potentially get that larger $500,000 exclusion, even filing as single or head of household in the year of sale. It's a very specific window, but incredibly generous.
That's a very compassionate rule. It really shows how the instructions go beyond just numbers, providing specific scenarios that could apply directly to your life, someone listening right now, and save a substantial amount.
Absolutely.
Yeah.
And there's another significant one. For members of the uniformed services, the Foreign Service, or the Peace Corps, on qualified official extended duty.
Okay.
For them, the 5-year test period for ownership and use can actually be suspended while they're serving away from home. This means those periods of service essentially pause the clock. They don't count against your 2 out of 5-year requirement.
So the clock stops while they're serving overseas, for example.
Exactly. The suspension can last for up to 10 years. This is a very powerful provision for military families, diplomats, Peace Corps volunteers, who often have to move frequently and might otherwise struggle to meet the standard 2-year use requirement. The IRS gives a great example. Imagine someone buys a house in Virginia in 2012, lives in it for 3 years, then gets assigned to Kuwait for 8 years, from 2015 to 2023. They sell the house in 2024. Normally, they'd fail the use test because they haven't lived there in the last 5 years, but they can elect to suspend that 5-year test period during their 8 years of service. This effectively allows them to meet the ownership and use requirements because those 8 years of service don't count against their qualifying period. Their 3 years of use before service still counts within the relevant time frame.
That is incredibly helpful for service members, a real recognition of their situation.
It is. But, and this is always critical with tax benefits, there are situations where you cannot exclude gain from your home sale, even if you seem to meet the ownership and use tests.
Ah, the caveats. Always caveats.
Always. A key example the instructions point out is if you acquired your home in a like-kind exchange, that's a Section 1031 exchange, often used for investment properties, where all or part of the gain on the property you gave up was not recognized. If you then sell that home you acquired via the exchange within a 5-year period starting from the date you acquired it, you generally cannot use the home sale exclusion. This rule prevents getting a double tax benefit deferral plus exclusion.
Okay, so 1031 exchanges and home sales need careful planning within that 5-year window.
Definitely. Also, remember, if you do receive a Form 1099 Asterisary reporting the proceeds from the sale of your home, which often happens, especially if the gain is large, or the closing agent isn't sure if you qualify for the full exclusion, or if you simply can't exclude all of your gain because it exceeds the $250K, $500K limit, then you must report the transaction on Form 8949.
Even if some or most of it is excluded.
Yes. You report the gross gain first. Then, to account for the exclusion, you make an adjustment using a specific code H for home sale exclusion on Form 8949. You enter the amount of the gain you're excluding as a negative number in column G. So, for instance, if you have a $300,000 gain and qualify to exclude $250,000, you report the $300K gain as calculated, then enter it in $250,000 with code H. The net result flowing to Schedule D is just the taxable $50,000 gain.
That makes sense. You show the full picture, but then explicitly subtract the excluded part. What about losses on a main home? We know they're not deductible, usually.
Correct. Losses on personal use assets like your main home are generally not deductible. However, and this catches people, if you do receive a Form 1099- for the sale of your main home at a loss, you still have to report that transaction on Form 8949.
Even though there's no deduction, why?
Primarily for matching purposes. The IRS got the 1099-S showing proceeds, so they expect to see a corresponding transaction on your return. You'd report the sale, calculate the loss, but then you use code L in column F of Form 8949 and make an adjustment in column G equal to the amount of the loss. This results in a zero outcome in column H, showing no taxable gain or deductible loss. It just tells the IRS, yes, I sold it. Yes, there was a loss. No, I'm not deducting it. Prevents follow-up questions.
Okay, vital for avoiding those IRS notices. Report everything, use the codes. Good advice. Now, let's pivot. Let's talk about another potentially incredible tax-saving opportunity, one that can be truly revolutionary for eligible investments. Unlocking gains with qualified small business stock, or QSB stock. Section 1202.
Yes, Section 1202. This is not just a minor tax break. It is potentially a game changer.
It sounds like it. The power here seems massive, potentially allowing you to exclude a significant portion, maybe even all, of your eligible gain from tax.
That's exactly right. It's a huge incentive. The actual exclusion percentage varies depending on when you acquired the stock, but listen to this. If you acquired qualified QSB stocks after September 27, 2010, you can potentially exclude up to 100% of the eligible gain, subject to certain overall limits per issuer.
100% exclusion, that's amazing. Tax-free growth.
Essentially, yes, within limits, but imagine the power of an investment growing entirely tax-free. It allows you to compound wealth without the drag of capital gains taxes. This isn't just a minor tweak. It's a fundamental shift in how you might view investing in certain early-stage companies. It has the potential to create significant, even generational, wealth entirely shielded from federal capital gains tax.
Okay, I'm hooked. 100% exclusion sounds too good to be true. What's the catch? There must be strict criteria.
Oh, there are. Absolutely. It's a truly revolutionary benefit, but it comes with very stringent criteria. This isn't just any stock in any small company. The instructions lay out 5 very specific tests, and all of them must be met for the stock to qualify.
Okay, lay them on us. Test number 1.
First, it must be stock in a C corporation. Not an S corporation, not an LLC taxed as a partnership. It has to be a C corp.
C corp only. Got it. 2.
Second, the stock must have been originally issued by the corporation after August 10th, 1993.
Yeah.
Older stock doesn't qualify.
Okay. Post-August 93. 3.
Third, this is key. At the time the stock was issued and immediately afterwards, the corporation must have had total gross assets of $50 million or less. This ensures it's truly a small business under this definition.
$50 million asset test at issuance. Makes sense. Number 4.
Fourth, you, the investor, must have acquired the stock at its original issue. This means you generally bought it directly from the company, or perhaps through an underwriter in an IPO, in exchange for money, other property, not including stock, or as payment for services you provided to the corporation. Buying it from another shareholder on the secondary market generally won't qualify, although there are specific rules for inheriting QSB stock or receiving it as a gift that might allow it to retain its character.
Original issue acquisition. Okay. And the 5th test.
Fifth, and this is crucial for the company's ongoing operations. During substantially all the time you held the stock, the corporation must have remained a C corporation. And also, during substantially all your holding period, at least 80% by value of the corporation's assets must have been used in the active conduct of one or more qualified trades or businesses. And finally, it can't be certain types of excluded corporations, like a DIS, a REIT, a RIIC, or a cooperative.
Okay, so the company has to stay a C corp and be actively running a qualified business with most of its assets. That sounds like it requires ongoing monitoring.
It does. This isn't just a passive investment in, say, a holding company that just owns other stocks. Section 1202 is specifically designed to incentivize investment in active operating businesses that are expected to generate economic growth and jobs. That policy intention is quite clear.
And you mentioned qualified businesses. I have a feeling the IRS is pretty specific about what doesn't count there, too.
You have a very good feeling. Yes, the IRS is quite particular about what is not a qualified trade or business for QSB stock purposes. The instructions list several specific exclusions, and it's essential investors check this carefully. Generally, businesses involving professional services are out. Think health, law, engineering, architecture, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services. Basically, any trade or business where the principal asset is the reputation or skill of one or more of its employees.
So my friend's successful law firm or consulting practice stock likely won't qualify.
Highly unlikely based on those exclusions. Also, any banking, insurance, financing, leasing, investing, or similar business is generally excluded. Even farming businesses, including raising or harvesting trees, are typically out. And finally, businesses involved in the production of products for which percentage depletion can be claimed, like oil and gas, or those operating a hotel, motel, restaurant, or similar business, also generally on the excluded list.
Wow. That excludes quite a lot of common small businesses, restaurants, hotels, professional services.
It does. The focus seems to be more on technology, manufacturing, retail, wholesale businesses that aren't primarily service-based or reliant on specific employee skills or in those other excluded categories. The takeaway is due diligence on the type of business the C Corp operates is absolutely paramount before you assume Section 1202 might apply.
Absolutely critical due diligence. Okay, let's say you've done your homework, the stock meets all 5 tests, the business qualifies, you held it long enough, generally more than 5 years for the exclusion. How do you actually report this amazing exclusion on your tax return?
If your stock does meet all these demanding criteria, reporting the exclusion is relatively straightforward on Form 8949. You report the sale of the QSB stock just like any other stock sale dates proceeds basis, but then in column F, you'll enter the code Q. And in column G, the adjustment column, you'll enter the amount of the gain you're excluding as a negative number. So if you had a $100,000 gain from qualifying QSB stock acquired after September 27, 2010, and you meet the holding period, you'd enter $90,000 to $100,000 in column G with code Q. This adjustment is the mechanism that zeroes out that gain for tax purposes on your return.
Okay, code Q and a negative adjustment for the excluded amount. What if the gain came through a mutual fund?
Good question. If you received a capital gain distribution from a mutual fund or a REIT, and that distribution included eligible QSB gain, the process is slightly different but achieves the same result. You typically report the total capital gain distribution directly on Schedule D first. Then you'd use Form 8949 specifically to report the exclusion amount. You'd enter the name of the fund, indicate QSB stock exclusion, or similar, use code Q, and enter the excluded portion as a negative amount in column G. It ensures the excluded part is correctly subtracted from your taxable income.
Got it. So Form 8949 is key for documenting that QSB exclusion, whether from a direct sale or a fund distribution. Now, beyond just excluding the gain when you sell, is there anything else you can do with QSB stock from a tax perspective? Maybe if you want to sell but reinvest?
Yes, there is. Another powerful, though perhaps less known, strategy related to QSB stock is the Section 145 rollover.
Section 145 rollover, what's that?
This provides a way to defer gain rather than exclude it immediately. So what does this mean for you? If you sold QSB stock that you held for more than 6 months, note, only 6 months required here, not 5 years. Like the exclusion you can elect to postpone recognizing the gain from that sale.
Postpone the tax. How?
If you reinvest the proceeds from that sale into other QSB stock during a 60-day window that begins on the date of the sale.
So sell QSB stock, buy different QSB stock within 60 days, and you can defer the tax on the first sale.
Exactly. This is a truly impactful deferral tool. You don't have to recognize that gain immediately. It allows your capital to stay invested, potentially in another promising QSB company, and continue working for you without the immediate drag of paying taxes on the gain from the first investment.
How does the deferral work mechanically? Does the gain just disappear?
Not disappear, but deferred. The mechanism's at the basis of your new QSB stock, the replacement stock you bought, is reduced by the amount of the gain you postponed from the first sale. So effectively, that tax liability is pushed down the road. It will be recognized eventually when you sell the new QSB stock, unless perhaps that new stock also qualifies for the Section 1202 exclusion after a 5-year hold. It's a key strategy for active investors in the small cap space, maybe venture capitalists or angel investors who are looking to redeploy capital efficiently within the QSB ecosystem. It allows for continuous growth and flexibility without that immediate tax burden hitting their cash flow.
That sounds incredibly useful for staying invested in that sector. Does this rollover apply only to individuals?
Mostly. But the election isn't just for individuals directly selling stock. It can also be made by a pass-through entity, like a partnership or an S corporation, if it sells QSB stock. Or, interestingly, you as an individual partner or shareholder might be able to make the election if the pass-through entity sold QSB stock that it held for over 6 months and met the tests. You held your interest in that entity for the entire time the entity held the stock, and you then personally purchased the replacement QSB stock within that 60-day window using your share of the proceeds.
Okay, some flexibility there too. How do you report this Section 1045 rollover, also on Form 8949?
Yes, again using Form 8949. For the original sale, you'll report the transaction as usual. Then in column F, you'll enter the code R for rollover. And in column G, the adjustment column, you'll enter the amount of the gain you are postponing as a negative number. This signals to the IRS that this gain is being deferred under Section N45 and shouldn't be included in your current year's taxable income.
code R, and a negative adjustment for the deferred amount. Got it. Wow. Between the potential 100% exclusion and this rollover deferral, QSB stock really seems like a compelling, though definitely complex, tax-advantaged way to invest in small business growth.
It really is. High potential reward, but absolutely requires careful planning and documentation due to those strict rules.
Okay, moving on to another significant deferral and potential exclusion opportunity. Qualified Opportunity Funds, or QOFs.
Yes, QOFs. These are a newer tool established by the Tax Cuts and Jobs Act of 2017.
And the goal here is to encourage investment in specific areas, right? Low-income communities.
That's the policy aim, precisely. To encourage long-term investments in economically distressed communities designated as qualified opportunity zones across the country. The core tax mechanism is that you can defer tax on eligible capital gains, and that's almost any type of capital gain, short-term or long-term, from selling stock, real estate, art, whatever, by reinvesting those gains into a qualified opportunity fund, a QOF, within 180 days of realizing the original gain.
So sell something at a gain, reinvest just the gain part into a QOF within about 6 months, and defer the tax on that original gain?
Correct. That's the first major benefit.
Right.
Deferral. You don't pay tax on that reinvested gain right away. But here's where it gets really compelling, especially for long-term strategic planning.
Okay, what's the kicker?
You can defer paying tax on those original capital gains until the earlier of the date you sell or exchange your QOF investment, or December 31st, 2026. So there's an end date for the deferral itself.
December 31st, 2026. Okay, that's coming up.
It is. But the truly game-changing part, the real aha moment with QOF, is about the new investment. If you hold your investment in the QOF for at least 10 years.
10 years. Okay, long hold.
Any appreciation, any new gain on the QOF investment itself can be permanently excluded from federal capital gains tax when you eventually sell it after that 10-year mark.
Wait, so the original gain is deferred until potentially late 2026, and the gain on the QOF investment itself could be completely tax-free if held 10 years.
Exactly. It's a powerful double benefit. The deferral buys you time, and the potential back-end exclusion on the QOF growth is the major long-term incentive. It actively encourages patient capital investment in communities designated as needing it most, providing that compelling dual incentive, potential for significant social impact alongside significant personal tax benefits.
That is a very unique structure. How do you manage the reporting for this? It sounds like it needs careful tracking.
It absolutely does. To properly track your QOF investments and the deferred gains, you'll need to file Form 8997, Initial and Annual Statement of Qualified Opportunity Fund Investments, each year you hold the QOF investment, and again in the year you dispose of it. When you make the initial election to defer the gain by investing in a QOF, you'll report that deferral on Form 8949. You report the original sale that generated the gain, then use code Z in column F and make a negative adjustment in column G for the amount of gain you're deferring into the QOF.
Code Z for Opportunity Zone Deferral.
Got it.
And Form 8997 annually to keep track. Okay. And finally, on the exclusion front, you mentioned briefly some geographic specific ones, DC zone assets and qualified community assets.
Yes, these are a bit more niche, perhaps less broadly applicable now as the qualifying acquisition periods have largely passed, but they function on a similar principle to the QSB stock exclusion. They offered a way to exclude qualified capital gain from the sale or exchange of certain assets like stock, partnership interests, or business property located in specific zones, like the DC Enterprise Zone or certain designated renewal communities, provided the assets were acquired within certain time windows and held for more than 5 years.
Similar idea. Hold specific assets in specific places for a long time, get a tax break.
Exactly. While more targeted, they demonstrate that broader principle we see in the tax code, using investment location as a lever for tax benefits, trying to incentivize development or investment in particular geographic areas. The instructions detailed the very precise acquisition periods, for instance. DC zone assets generally had to be acquired after 1997 and before 2012. And importantly, gain attributable to periods after certain cutoff dates, like Dec 31, 2016 for DC zone assets, is generally not eligible for the exclusion, even if you met the holding period. So these were time-limited incentives. And, just like the home sale and QSB exclusions, gains from sales to related parties generally don't qualify for these exclusions either.
Okay. How are these reported if someone still has qualifying assets?
If you happen to have gains eligible for these exclusions, you'd report them on Form 8949 using code X in column F and entering the excluded gain amount as a negative number in column G.
Codex for these specific zone exclusions. Okay, that covers a lot of ground on exclusions and deferrals, home sales, QSB stock, QOFs, rollovers, these zone assets. Lots of ways to potentially save tax on the gain side.
Absolutely. Significant opportunities if you qualify and plan carefully.
Now, let's shift gears. Let's talk about the other side of the coin, losses. Because while everyone loves talking about gains, knowing how to navigate and, importantly, maximize the benefit of losses is just as critical, maybe even more so, for smart, long-term tax planning.
Couldn't agree more. Managing losses effectively is key.
So what's the core rule for deducting capital losses? How much can you actually deduct each year?
The basic rule is this. You can deduct your capital losses to the extent of your capital gains. So losses first, offset gains. If you have more losses than gains, you can then deduct an additional amount against your other types of income, like wages or interest.
Okay, losses offset gains first. How much extra can you deduct against ordinary income?
That additional deduction against ordinary income is limited. It's capped at $3,000 per year for most filing statuses, single, married filing jointly, head of household. If you're married filing separately, that limit is halved to $1,500 per year.
$3,000 against ordinary income. $1,500 if MFS. That seems kind of low if you had a really bad year in the market.
It can feel low, absolutely, especially if you have substantial losses exceeding your gains, plus that $3,000. But here's where the long-term strategic benefit truly shines. What's fascinating and incredibly valuable is that even if your net capital losses exceed that annual deduction limit, they are not lost forever.
Oh, they don't just vanish if you can't use them.
Not at all. You get to carry forward any unused capital losses to future tax years, indefinitely, in fact, until they are fully used up.
Carry forward indefinitely. That's huge.
It's incredibly powerful. This isn't just some minor consolation prize. It's a potent hedge against future tax liability. It allows you to strategically use those past losses to offset future capital gains in later years. And if you still have losses left after offsetting future gains, you can continue to use that $3,000, $1,500 MFS deduction against ordinary income each year until the entire carried over loss is fully utilized. It's a vital piece of your financial toolkit. It ensures that no market dip, no individual investment loss ever truly goes entirely to waste from a tax perspective. The instructions even provide a detailed capital loss carryover worksheet to help you calculate your exact carryover amount, underscoring the ongoing value of meticulously reporting all your capital gains and losses each year, even if they aren't fully deductible in the current year. This foresight can significantly mitigate your tax liability over many years.
That's a massive relief. Knowing that market downturns or big individual investment losses aren't just dead money for tax purposes, that they create this asset, essentially, this carry-forward loss. That's critical for long-term perspective.
Absolutely. It turns a negative event into a future potential positive on your tax return.
Let's talk about the flip side again. The trap of non-deductible losses. We touched on losses from selling your main home. Are there other situations where a loss, even if it feels very real financially, simply isn't deductible for tax purposes? This seems like a place where investors could easily get tripped up.
You're right. This is a common area of confusion and potential mistakes. So this raises the important question. When can't a loss be deducted? The instructions are very clear, as we discussed with homes. A loss from the sale or exchange of a capital asset held for personal use is never deductible. This isn't limited to just your main home.
So like what else? That vacation home we mentioned.
Yes, a vacation home you sell at a loss. Your personal car, furniture, jewelry, artwork hanging in your house. If you bought it for personal enjoyment or use, and you sell it for less than your basis, that loss provides zero tax benefit. It's simply a personal expense in the eyes of the tax code. For instance, imagine you bought a boat for personal use for $50,000 and later sold it for $30,000. That $20,000 loss, not deductible. And again, just like with the home sale loss, if you happen to receive a Form 1099-S or maybe a Form 1099-K for online sales reporting proceeds from selling personal use property at a loss, you still generally have to report the transaction on Form 8949. You'd use code L and adjust the gain loss to 0 to show it's non-deductible, mainly for that IRS matching purpose.
Okay, personal use property losses, generally no deduction. Got it. What else?
Here's where it gets really tricky, and it's a very common trap that the IRS watches closely. Losses from sales or exchanges between certain related parties.
Related parties? Who counts as related? Just family.
It includes family, but the definition is quite specific and broad under the tax law. It definitely includes direct or indirect sales or exchanges between members of a family. And family here means your spouse, your brothers and sisters, whether whole or half-blood, your ancestors, like parents, grandparents, and your lineal descendants, children, grandchildren. Note that in-laws are generally not considered family for the specific rule.
Okay, spouse, siblings, parents, grandparents, kids, grandkids. What about non-family?
Yes, it goes beyond immediate family. It also applies to sales or exchanges between an individual and a corporation, where that individual directly or indirectly owns more than 50% of the corporation's stock value. Two corporations that are members of the same controlled group, a grantor and a fiduciary of any trust, a fiduciary of a trust and a beneficiary of that same trust, fiduciaries of two different trusts if the same person is the grantor of both trusts, a fiduciary of a trust and a beneficiary of another trust if the same person is the grantor of both trusts, a fiduciary of a trust and a corporation where more than 50% of the stock is owned, directly or indirectly, by or for the trust or by or for a person who is a grantor of the trust. Certain relationships involving partnerships and S-corporations and their owners, partner shareholders.
Wow, that is a much longer list than just family. It covers a lot of business and trust relationships too.
It absolutely does. The underlying principle is preventing taxpayers from generating artificial losses through transactions with parties over whom they might have significant influence or shared economic interest. And the rule is absolute. Any loss resulting from a sale or exchange of property, directly or indirectly, between these defined related parties is explicitly non-deductible. The loss simply vanishes for tax purposes for the seller.
Gone. Poof. No deduction, no carry forward.
Correct. It provides zero tax benefit to the seller. For example, if you sold investment land that cost you $150,000 to your sister for its current fair market value of $100,000, that $50,000 loss is completely non-deductible for you because you and your sister are related parties.
Okay, that's a harsh rule if you didn't know about it. How do you report that non-deductible loss? Same as the personal use loss.
Yes, the reporting mechanic is similar. Even though the loss is non-deductible, you must still report the transaction on Form 8949. You'll use that same code L in column F to indicate a non-deductible loss. Then, in column G, you enter the amount of the disallowed loss as a positive number, an adjustment increasing the gain, decreasing the loss. This adjustment effectively cancels out the loss you calculated, resulting in 0 in column H. Again, it ensures transparency with the IRS. You're showing the sale happened, but you're correctly indicating that no loss deduction is being claimed due to the related party rules. So the clear strategy here is avoid selling assets at a loss to related parties if you want any tax benefit from that loss.
Absolutely critical planning point. Don't sell losers to your brother or your controlled corporation. Okay, what's another major loss trap? I feel like there's one more big one people talk about.
Yes.
The wash sale rule.
Yes, the wash sale rule. This is a big one, especially for active investors and traders, and it catches people out surprisingly often, particularly around year-end when folks might be trying to harvest losses.
Okay, what exactly is a wash sale?
The rule is designed, again, to prevent people from creating artificial tax losses while essentially maintaining their economic position in an investment. A wash sale occurs when you sell or otherwise dispose of stock or securities, including contracts or options to buy or sell them at a loss. And then within a specific window of time, 61 days in total, you do one of the following. 1, you buy substantially identical stock or securities. 2, you acquire substantially identical stock or securities in a fully taxable trade. 3, you enter into a contract or option to acquire substantially identical stock or securities. 4, or importantly, you acquire substantially identical stock or securities for your IRA or Roth IRA.
Okay, so sell at a loss and then buy back something substantially identical within 30 days before the sale, on the day of the sale, or within 30 days after the sale. That 61-day window is key.
Precisely. That 30 days before, day of, 30 days after period is a wash sale window. And substantially identical usually means stock of the same company. It can get more complex with bonds or options, but for common stock, selling IBM at a loss and buying IBM back within that window is the classic wash sale.
What's the impact? What happens to the loss if it's a wash sale?
So what does this all mean for your bottom line? The most important takeaway is that the loss from that wash sale is not deductible in the year of the sale. It's disallowed.
Not deductible. Okay. Is it lost forever, like the related party loss?
No. Thankfully, it's not lost forever in most cases. The disallowed loss amount is generally added to the cost basis of the new substantially identical stock or securities that you acquired, the ones that triggered the wash sale rule.
Ah, so the basis of the replacement stock gets increased by the amount of the disallowed loss.
Exactly. This effectively defers the recognition of that loss. You'll eventually get the tax benefit of that loss, but only when you sell the replacement stock, assuming that sale doesn't trigger another wash sale. It's a very common pitfall, Investors need to be acutely aware of it, especially if they're actively trading or trying to do tax loss harvesting, selling losers to offset gains. You have to wait more than 30 days before buying back the same or substantially identical security.
And you mentioned brokers often report this.
Yes, your Form 1099-B from your broker will often identify wash sales, especially if the purchase and sale happened within the same account and involved covered securities, generally stock acquired after 2010. They'll often show the disallowed loss amount right on the form. However, the wash sale rule applies even if your broker doesn't report it. For instance, if you sell stock at a loss in your taxable brokerage account and then buy the same stock back within 30 days in your IRA that's still a wash sale, the loss is disallowed, and the broker for your taxable account might not even know about the IRA purchase. You are ultimately responsible for tracking and reporting this correctly.
Good point. The responsibility is on the taxpayer. How do you report a wash sale loss on Form 8949?
You report the sale transaction as usual. Then in column F, you enter the code WF for a wash sale. In column G, the adjustment column, you enter the amount of the loss that is being disallowed by the wash sale rule as a positive number. This positive adjustment cancels out the loss, bringing your recognized loss for that transaction to zero or reducing it if only part of the sale was a wash sale.
Code W and a positive adjustment. Okay?
Yeah.
That makes sense. It adds the loss back, so it's not deducted.
Precisely. And then you remember to add that disallowed amount to the basis of the replacement shares for future tax calculations.
All right. That covers the major loss rules deductions, carryovers, and the big pitfalls. Personal use, related parties, and wash sales. Let's turn our attention now to some even more specialized considerations, things that might apply particularly to those listeners who are very active in the market, maybe thinking of themselves as traders rather than just investors.
Yes, the distinction between an investor and a trader is very important in the eyes of the IRS, and it carries significant tax implications.
And I recall you saying earlier, it doesn't matter if someone calls themselves a day trader on social media, right? It's about meeting the IRS definition.
Exactly. It's not about the label you use, it's about the facts and circumstances of your activity. To be considered a trader in securities by the IRS, you generally need to meet several criteria. You must seek to profit from daily market movements in the prices of securities, not primarily from dividends, interest, or long-term capital appreciation. Think short-term swings. Your trading activity must be substantial. There's no exact number, but it implies significant volume and frequency. You must carry on the activity with continuity and regularity. Sporadic trades don't count. And critically, you must be doing this with the intent to make a living or produce ongoing income from the trading itself, not just manage your own long-term investments. It's effectively treated as running a business.
Okay, so high frequency, short holding periods, substantial activity, intention to profit from daily moves, done continuously as a business. That sounds like a much higher bar than just being an active investor.
It is a significantly higher bar, and meeting it can be difficult. Most people who manage their own portfolios, even if they trade frequently, are still considered investors, not traders, by the IRS.
But if someone does meet that high bar and qualifies as a trader, what are the potential tax differences?
For a qualified trader, here's where it gets really interesting and potentially very advantageous, especially regarding losses. Traders can make what's called the mark-to-market election under Internal Revenue Code Section 475F.
Mark-to-market election, what does that do?
This election fundamentally changes how gains and losses are treated. If a trader makes this election, all gains and losses from the securities held in connection with their trading business are treated as ordinary income or loss, not capital gains or losses.
Ordinary income or loss, not capital.
Correct. And the most significant advantage here is on the loss side. Because the losses are ordinary, they are not subject to that $3,000 annual capital loss limitation against ordinary income that applies to investors.
Ah, so a trader with mark-to-market could potentially deduct all their net trading losses against other ordinary income in a given year.
That's the huge potential benefit. For very active traders, especially in volatile markets where large losses can occur, this could be a massive advantage compared to being limited to that $3,000 cap plus capital gain offsets. It offers a completely different kind of tax saving or loss utilization. Also, under mark-to-market, any securities held in the trading business at the end of the year are treated as if they were sold for their fair market value on the last business day of the year. Any resulting gain or loss marking to market is included in income for that year. You then adjust the basis of those securities to fair market value to avoid taxing the same gain again next year.
So you recognize gains and losses annually, even on positions you haven't actually closed?
Yes, That's the mark-to-market part. It can accelerate income recognition sometimes, but it also ensures losses are recognized promptly. However, this election is a serious commitment. It generally must be made by the due date, not including extensions, of the tax return for the year prior to the year the elections become effective. And once made, it applies to all subsequent years unless revoked with IRS consent, which can be difficult to get.
Okay, a big decision with strict timing rules. How does a trader with this election report everything? Still Schedule D.
No. If a trader has made the mark-to-market election, their gains and losses from their trading business securities are generally reported on Form 4797, Sales of Business Property, not on Schedule D or Form 8A949. And their trading business expenses, things like margin interest subject to limitations, data fees, software subscriptions, maybe home office expenses if they qualify, are deducted on Schedule C, profit or loss from business, just like any other sole proprietor business. They are treated as business expenses, not itemized deductions subject to limitations.
Schedule C for expenses, Form 4797 for gains losses. Completely different path than an investor.
A very different path. And importantly, the wash sale rules generally do not apply to a trader who has made the mark-to-market election for securities held in their trading business.
No wash sale rule either. That's another big difference.
It is. Again, qualifying as a trader and making the election requires meeting those high standards of activity and intent.
Definitely something for very serious full-time traders to consider carefully with professional advice. Okay, what about other complex areas for active investors like short sales, options?
Yes, those definitely have specific tax rules. Let's take short sales first. For tax purposes, a short sale isn't considered complete, and gain or loss isn't recognized until the property is delivered to the lender to close the short sale.
So tax happens when you close the position, not when you open it.
Correct. Determining the holding period for the gain or loss on a short sale can also be tricky. Generally, it depends on the holding period of the property you eventually use to close the short sale. However, there are special rules. For instance, if, on the date you entered the short sale, you or your spouse held substantially identical property for 1 year or less, or if you acquired substantially identical property after the short sale but before the closing date, then any gain when you close a short sale is generally treated as short-term capital gain, regardless of how long you held the property used to close the sale.
Wow, okay. So opening a short sale while holding the same stock short-term can automatically make the short sale gain short-term too.
Generally, yes. There are also rules that can affect the holding period of the substantially identical property you held when you entered the short sale. It gets complex, aimed at preventing manipulation of holding periods. Any short sale gain or loss is reported on Form 8949 in the year the position is closed.
Okay, short sales require careful attention to dates and holding periods. What about options? Buying or selling calls and puts?
Options also have specific reporting rules, primarily on Form 8949, assuming they are capital assets in your hands and not Section Well 56 contracts, which have their own mark-to-market rules, often reported on Form 6781. If you buy an option, a call or a put, and then sell it before it expires or is exercised, that's a straightforward capital gain or loss reported on 8949, based on your holding period of the option itself. If an option you purchased simply expires worthless, you recognize a capital loss. You report it on Form 8949 for the date it expired. You enter the description, put expired in column E for proceeds, and your cost basis in column D. The loss will be short-term or long-term depending on how long you held the option before it expired.
Okay, expired purchased options generate a loss. What about options you sell?
If you, as the writer or seller of an option, receive a premium and that option expires unexercised, that premium you received is treated as a short-term capital gain recognized in the year the option expires. You report this on Form 8949 as well, noting expired and the premium is the proceeds with zero basis.
Premium from expired written options equals short-term gain. What if the option is exercised?
If an option you wrote is exercised, the tax treatment depends on whether it was a call or a put. If a call option you wrote is exercised, the premium you received is added to the proceeds from the sale of the underlying stock. This increases your overall gain or decreases your loss on the stock itself, reported on Form 8949 when the stock is delivered. If a put option you wrote is exercised, meaning you are forced to buy the stock, the premium you received reduces the cost basis of the stock you acquire. It doesn't trigger immediate gain or loss, but affects the eventual gain or loss when you later sell that acquired stock.
Okay, so exercise option premiums adjust either the proceeds for calls or the basis for puts of the underlying stock transaction.
Exactly. These are advanced strategies, and the tax implications, as you can see, are very specific, requiring close attention to detail. The instructions lay out the precise methods for reporting these, including how to make adjustments on Form 8949 if, for example, your Form 1099-B doesn't reflect the premium correctly in the proceeds or basis reported for the stock transaction that resulted from exercise. You have to ensure the full picture is captured accurately.
Definitely sounds like an area where careful record keeping and understanding the mechanics are crucial.
Absolutely. And finally, let's just briefly touch on a couple of other noteworthy items that sort of highlight the evolving landscape or potential nuances. First, virtual currencies. The IRS has made it abundantly clear for several years now that certain virtual currencies, such as Bitcoin, are treated as property for federal tax purposes. This means the general tax principles that apply to property transactions like the capital gains and losses rules we've been discussing apply to transactions involving virtual currencies.
So selling Bitcoin, or even using it to buy goods or services, is treated like selling stock, potentially triggering capital gain or loss.
Generally, yes. Buying virtual currency is usually not taxable, but selling it for fiat currency, like US dollars, exchanging it for a different virtual currency, like Bitcoin for Ether, or using it to pay for goods or services, are all typically taxable events where you need to calculate gain or loss based on the difference between your basis and the fair market value at the time of the transaction. This highlights the IRS's ongoing efforts to apply existing tax frameworks to new asset classes. They direct taxpayers to irs.gov virtual currency FAQs for more specific guidance, as it's a rapidly evolving area.
Okay, good flag for anyone involved in crypto. What was the other item?
The others is just a reminder that not all income from debt instruments is treated as capital gain. Specifically, gains from selling certain complex financial instruments like market discount bonds or contingent payment debt instruments might actually be treated in whole or in part as interest income rather than capital gain.
Interest income, why does that matter?
It matters because interest income is taxed at your ordinary income tax rates, which, as we've discussed, are typically higher than the preferential long-term capital gains rates. So what looks like a gain on a bond sale might end up being taxed at a higher rate. Similarly, losses on these types of instruments can sometimes be treated as ordinary losses or capital losses, depending on factors like prior inclusions of original issue discount, OID, which is a form of interest. This is a highly detailed area, usually relevant for more sophisticated fixed income investors, but it serves as a good reminder. The default assumption of capital gain isn't always correct, especially with complex securities. Understanding these nuances can prevent unexpected tax bills or help identify potential ordinary loss deductions.
Excellent point. Don't assume, verify the character of the income or loss, especially with complex investments. Wow, what an incredibly detailed yet practical deep dive into the world of capital gains and losses, all guided by those IRS instructions. Let's try to quickly recap some of the most impactful tax-saving strategies we've uncovered today. We started with that really substantial home sale exclusion up to $250K or $500K tax-free gain potential on your main home. Huge. Then we explored the truly powerful Section 1202 exclusion for qualified small business stock, that incredible potential for up to 100% tax-free growth on eligible gains if you meet all the strict criteria. Plus, the related Section 125 rollover, allowing deferral of QSB stock gains to keep capital compounding. We also covered the unique long-term benefits of investing in qualified opportunity funds deferral up front, and that potential for permanent tax exclusion on the QOF growth itself if held 10 years. And critically, we detailed the importance of managing capital losses, effectively using them to offset gains, taking the $3K deduction, and crucially carrying forward unused losses indefinitely, while also being vigilant about avoiding those common pitfalls. Non-deductible personal use losses, the strict related party loss rules, and of course that tricky wash sale rule.
Absolutely. And if you connect this all back to the bigger picture, the goal here wasn't necessarily to turn everyone listening into a certified tax expert overnight. Rather, it's about empowering you, the listener, to become a more informed, more proactive, and ultimately a more empowered investor. The IRS instructions, as dense as they can seem, really do provide the blueprint. And hopefully with this deep dive today, you have a much clearer understanding of how to actually apply that blueprint to your own unique financial situation. It's about transforming potential tax liabilities, things you might have just paid without thinking, into very real savings, or powerful deferrals that help your wealth grow faster over time. This knowledge really does empower you to make strategic decisions.
So what does this all mean for you listening right now? Maybe consider this final thought. Beyond just using this information to prepare your next tax return more accurately, how might these specific rules we discussed today about holding periods, about basis tracking, about the benefits of QSB stock or QOFs, about managing losses, how might they influence your investment strategy moving forward? Thinking proactively about how and when you buy and sell, what kinds of assets you choose to invest in, considering things like QSB potential, and how diligently you document everything. Could that be the key to significantly positively impacting your long-term wealth accumulation? What's one thing you might do differently next time you look at your portfolio or consider selling an asset now that you have these insights in mind? Thank you so much for joining us on this deep dive into the often complex but ultimately navigable world of capital gains and losses. We sincerely hope this has given you a valuable shortcut to being well informed and ready to make smarter, more tax efficient financial moves.